What's going on YouTube? This is Matt Faircloth from the DeRosa Group, and today we're going to talk about something that's just insane, and it's maybe a foretelling of things that are going to happen in the future, and that is the foreclosure on an insane amount of units, 3,200 units under foreclosure or already turned back to the bank or even already turned over to receivership or other buyers in the city of Houston, all from one operator. I've been able to bring on Vincent Celeste and Herve Francois just so we can have a brief roundtable discussion. Really hope you guys enjoy our insights, and if you guys enjoy these insights here, make sure you join our DeRosa Group Facebook page, which is DeRosa Insiders. That is a free community that we go live on every Friday, noon Eastern. And you can also check us out at DeRosaGroup.com to hear more what we've got to offer. So let's get into the conversation.
Here's the deal with the Houston thing. So I read the Wall Street Journal article on it. And as you probably would suspect, this has been in pipeline for a while. And so I heard about this deal 2 weeks ago. Some of these properties have already been auctioned off. They're already in new hands to go in, sometimes with very low equity exposure, raising as little money as possible to get the deal done because that ups investor returns. If I don't raise very many reserves, I don't have that much equity into the deal. So every dollar I make makes more money for the deal, right? So you go in low equity. They also went in with heavy pref. This operator had 3 deals that were in receivership, meaning beginning of foreclosure, and then they bought another 1,000 units. So the banks and the underwriters and all those kinds of things kept the party going for this operator while they continued to buy more deals, collect those acquisition fees, while they were already losing properties while they were buying more properties. So think about that. I mean, think about the underwriting guidelines that were there.
Well, man, I mean, at some point the lenders are going to go ahead and crisscross and be like, hey, wait a minute, you got this.
It's bridge debt, Herve. They bought everything on bridge debt. So you buy one deal from Bancorp, buy another deal from Redicap, buy another deal from XYZ company, right? And nobody wants the party to stop. The brokers didn't want the party, the mortgage brokers didn't want the party to stop. So they kept funding them through different banks and everything like that, right? The mortgage brokers also who was selling them the pref equity. So they didn't want that party to stop either, because every time a mortgage broker sells pref equity with a deal, they get like 3%, right? So this guy needs 5 million.
Pref equity was expensive. Pref equity.
We've gotten quotes on it. I mean, Herve, that's not cheap.
It's not cheap.
But pref equity is like a little hand grenade. I mean, a lot of times you don't have to make any payments on it, but it does come due. And anyway, long story short, this guy bought 3,200 units in Houston, all of which have either gone back to the bank or have already handed over to new owners or are in the middle of receivership right now. It's a very sad story. A lot of times people look at LP investors. I want to bring up one other person that's at fault here, aside from Sumrock, the operator, the mortgage brokers, everybody that was involved in this thing. They just wanted to keep making money and keep the carousel going, including the real estate brokers that were putting properties in front of these guys. One last person that needs to take some ownership, and maybe I'm touching the third rail here, is the LPs that invested in that deal, right? At the end of the day, Herve, you were on the street, right? And so your job there was to vet the operator, man. Although an investor is passive, it is not, they do not give up all the fiduciary responsibilities to vet operators, to make sure they know what to get themselves into, right? And I'm not saying that, they own the whole thing and buyer beware, but at the end of the day, there's some culpability that falls over to the LPs that got in on stuff like this and should have looked a little deeper at the financial stack. Maybe got themselves a little more financial education or had an financial advisor sitting over their shoulder saying, hey, this looks too good to be true.
Beyond the obvious skills of finances that I picked up on the street, Wall Street, the Wall Street, finance, but there was a lot of marketing as well, right? And so you ask yourself, how do investors get duped? Investors in the Madoff fund, right? Wealthy people too, other professional athletes, actors and actresses, right? The Leo DiCaprios of the world, they're getting duped by, we're going to go and hang out in the south of France, we're going to party it up and everything, and they're signing multi-million-dollar checks to these ghosting, operators. And one of the big ways that LPs, investors get duped, either by Bernie Madoff or this gentleman down in Houston, with all these deals in Houston, is marketing. And I don't know anything about the sales pitch that they use to get those LP investors into those deals down in Houston, but you're saying that, hey, banks closed their eyes on it. So they're funding this person from the next deal, the next deal, the next deal. The LPs are hearing this. Hey, well, there's no reason why the banks would be, no way in the world the banks would continue to fund this person if this person, wasn't legit. He wasn't a legit operator and he wasn't paying his P&I back in full at the, every month and so on and so forth. So it's like, checks all the boxes. Sounds good. He has experience. He's borrowed before. He's been paying back some equity to investors and so on and so forth. So people kind of just jump on that bandwagon.
Well, you know what it is, Herve? You let other people end up doing the due diligence for you at some point, don't you? You're like, well, if the mortgage broker is behind the deal. Yeah, and if they underwrote the deal, and if they wouldn't, allow him to do a bad deal, would they? Or even like folks like the gurus that he's got behind him, because I believe the guru that I just mentioned either did or is speculated to be a key principal on some of these deals. So
that's another thing. And he has a big name, as you know. He's had a lot of success. He's had a lot of success.
He does. And you can't say that he's out there just, selling snake oil to everybody. I mean, maybe somebody who misinterpreted a bit of his advice or whatever. But at the end of the day, if you're just collecting big checks from students and not providing enough oversight and trying to go as wide as you can, then you're on the greed train too, to collect as many student fees as you can, just to keep that party going as well. And I'll tell you that a lot of this industry, the multifamily industry, has been propped up on people trying to keep the party going the last 10 years. I mean, brokers that you and I talked to are trying just crossing their fingers and really hoping the cap rates stay at 4.5%. Yeah, and mortgage brokers hoping people continue to buy or refi or whatever. Nobody wants this thing to take a break because there's just not enough money in this thing taking a break, although it really ought to. And that's what happens. When things really ought to take a break, but they don't, they end up breaking.
Now, what's unfortunate, but at the same time, I think is a good thing. We're investors, right? We're investors in this. We're players in this. We're operators. We preach it. We educate it, and so on and so forth. We get other people involved. We go to conferences. We talk and so on. So we love the industry, right? It's what we do. It's how we butter our bread and take care of our family and so on and so forth. But this might be the gut punch that the industry needs. There may be some additional time will tell. Hopefully not. I'm not hoping for anything, to be disastrous.
I'm not either, right, but I don't think this is big enough. This isn't big enough. You need like 4 more like this for the industry really to fall under scrutiny, because what's going to happen is they'll start blame gaming and pointing at this one operator and probably unfairly pointing at the guru that taught him, right? Because he's probably got the deepest pockets alongside the operator that took all those acquisition fees, right? So I think that it's yet to be seen, but I think that you're going to need a few more deals like this to hit before people will say, hey, wait, what are you doing? People have already said that too. Like, nobody's buying deals on bridge with a bunch of crap behind it anymore. Only fools are doing that.
Right.
But this is a symptom of the frenzy that happened a year and a half, 2 years ago, and that is slowing down now. So I don't know what the future is going to hold, Herve. I mean, I don't think that multifamily is going to crash. I don't see.
No.
Yeah, and I'll tell you why. Yeah, I'll tell you why. There's just too many people out there that have stable properties. We do, right? And that's the Claudia's question. DeRosa owns quite a few stable assets. I mean, we got deals that have financing at 3.2% fixed, and we do have floating rate debt deals, but they all have plenty of cash, millions of dollars in cash, and they all have rate caps. And so if we are getting charged more interest, we're getting reimbursed by the rate cap insurance policy. And we've got a business plan with it, aside from just crossing our fingers and hoping that things get better. We've got a business plan to get those properties, into fixed rate debt, and it still would make fiscal sense even at today's rates, right? So we're just more conservative of a company, and that's the difference, I think, to Claudia's question is, if you're going to go out and buy 3,200 units like this guy did in 3 years, can't do that without being really aggressive. And I would say dropping a lot of your conservative standards, like going just pedal to the metal, balls to the wall, right? That's not DeRosa's mindset. That's not what we do. We don't force a square peg into a round hole. And the only way to grow that way in one market, these were all in Houston, in one market, even though it's a good market, the only way to grow like that is, I think, to throw a lot of caution to the wind. That's not what we do. There's just too much conservatism baked into our deals and most other operators' deals. And that's my last point, is that this is going to be, I think, and I think this is the last one, you're gonna hear more, but stuff like this is going to be what ends up getting pointed to with, like, cancel rent came out because there were a handful of landlords that were pushing heavy on their tenants to pay their rent during COVID, right? Not giving any grace during COVID or whatever, right? Okay. Those handful of landlords gave the entire industry a bad name, right? What we're going to have to deal with is the syndicator space is going to get viewed as a bunch of snake oil salesmen because of this one deal and maybe a few more. So best thing we can do is to teach our investor base that we're not that guy.
Is how are we different, right? How do we differentiate ourselves? It's more than we're not that guys. This is how we do it. If you were to draw a line down a piece of paper and you say, this is how DeRosa finds its deals, raises money for its deals, manages deals, and then on the other line of that paper, find out how this person in Houston finds his deals, raises capitals for his deals, manages, you're going to see two different sets of answers, right? And obviously the person in Houston, bad oversight, bad controls, perhaps not good systems, certainly not discipline, putting too much debt on the property and so on and so forth. Times like these, when things go bad, the investors, they're the ones that always wind up getting burned. And they're going to put direct anger at the operator and so on and so forth.
You got to throw it at somebody.
But this is, at least in Wall Street world, when the SEC comes in, it's not just the operator. They go after everybody. Everybody. Where were the lawyers? Where were the lenders? Where was the insurance company? Where was they go after?
Well, not just that, right? Like, because think about I was around in 2008. I know you were too, right? Yeah. What happened was a lot of mortgage brokers that were bad actors made a bad name for a lot of mortgage brokers, and you end up getting regulation like Dodd-Frank, which was good, right. But it really tied a lot of people's hands that were good operators, and it made their lives just that much harder as good mortgage brokers, good realtors that weren't out there selling snake oil to people. So that's likely what will happen is our trade will likely become more regulated. I think, unfortunately, because the SEC was headed the other direction, they were about to allow more and more rules to get lifted with regards to non-accrediteds getting into the space.
Exactly.
Yeah, a lot of that was going to get more allowed. If you look under Obama, there was the Jobs Act that allowed a lot of spaces like crowdfunding portals and people to get in at like $1,000 into any type of private placement, stuff like that. A lot of that's either going to go away or become heavily regulated, and so this space of getting involved in something different, it is going to become less accessible, and operators like ours are probably going to fall under more scrutiny. I wouldn't be surprised if right now you want to file a 506C or a 506B filing to do a syndication. It is a one-page piece of paper on the SEC's website, right? Yep. It's likely going to get a lot more complex to form a 506B and 506C because of SEC oversight.
Their number one priority is that small-time investor. That's who they're looking to protect, right? They're not going to care. I'm not going to lie to you. They're not going to care about Brad Summerall. They're not going to care about the operators.
The investor's lawyers will.
The
investors' lawyers are going to go after them, but they're not going to regulate them. I guarantee those investors' regulators. Whether that's rightful or not, he's got the deepest pockets in the situation. So
how do you not go? As a lawyer, you always have the deepest pockets first, right? And then you go after everybody.
It's different. So you got legal ramifications for that one matter. That's one thing. That, to me, that's a microcosm. That's going to happen this. But what's going to happen further, and you need a few more deals like this to happen, big 4-digit portfolios to fall apart. And then the SEC is going to come into the space and say, okay, because of this, like 0.01% of the population, we're not going to change the rules for everybody. But it all goes back to the politics of greed, right? And the way things go when people want to keep parties going. When there's a party going, and the music's blaring, everybody's having a good time, and the cocktail's flowing, and nobody wants the party to stop, right? That's what happened. And in some ways, the party's winding down. I think we've already had last call on in the multifamily world, right? But it's not over. People are still going to transact multifamily. Don't get me wrong, but I think that the unnecessary, over frothy party of multifamily is about to wind down, specifically in markets like Houston. I mean, you make the list: Houston, Austin, Phoenix, Atlanta, Orlando. Markets that were overheated to begin with.
Where I would say there's a silver lining, I'm not so much worried about the markets, right? Because I got to believe that this huge portfolio that is failing is not so much about anything bad specifically happening in the city of Houston, right? There's still a lot of good deals that transacted in Houston, multifamily, that are doing just fine. They're well capitalized and everything else like that. If I see a silver lining in this, I think, and this may sound weird, but I think this is going to ultimately be a very, very good thing for operators such as us. For two reasons, or one big reason, this is going to be a weeding out. It's going to get rid of those small-time snake oil salesperson operators that probably shouldn't have in this industry to begin with. They don't know what they're doing, but they're pitching like DeRosa is pitching or like someone else is pitching. That stuff's going to go away, right? And I think that's going to allow a firm like us that's very transparent and open. And we educate, and we do chats with Mats on Fridays and other webinars, educating folks, our masterminds and so on and so forth, where we are going to have an opportunity to rise to the top. There's not going to be as many operators next year as there is today. There's not going to be as many syndicators in 2 years from now as there is today. We're still going to be around because of our dedication, our focus, our discipline, and so on and so forth, transforming lives through real estate and so on. I think this ultimately is going to be a good thing for DeRosa Group and other syndicators like DeRosa Group, because something needed to happen to get rid of the froth.
I just want to point out too, kind of to your flavor to why being good for the industry, whatnot. I think this is kind of a testament to why value add is so important. Right, when you can increase the value of a property intrinsically, we're not just taking over properties and changing light bulbs. These are hard jobs, and we are changing light bulbs too, making the light.
Sometimes you got to put in light packs,
yeah. But you are actually making that property more valuable and more stable intrinsically from the bones of it. right? And there's something to be said about taking control of the business plan in that way and not relying so much on the market, although everyone is affected greatly by the market, maybe even the most greatly, right? But by taking on large value add projects, you're able to control kind of the business plan to a degree greater than if you take over something that doesn't need that type of work.
Well, that's what the word on the street up until recently has been appreciation, right? I mean, I saw many people that bought deals. I saw lots of stuff got bought it, a year ago and is selling it for, double
in acquisitions.
What they bought it for. Yeah, everybody brings us out, like acquisitions for brokers selling stuff or whatever, where the seller literally bought the property, did nothing to it, is trying to sell it for $15 million more than they paid for it, And I mean, it's like, I don't know if they're going to get their numbers. Maybe they do, maybe they won't, but it's not going to be from us, because we're not going to play that appreciation game in the future. We're going to play the cash flow game. And the problem is these deals that are being sold at appreciation today aren't going to make cash flow tomorrow. They're just not. And I think that the word is changing in general. And the guy that bought these 3,200 units was probably playing an appreciation game. That's likely how a lot of those folks that coach tell them what to do. Like, hey, push rents by $50 and your NOI goes up, dramatically. And then, cap rates stay down, and then magic fairy dust, and you can sell it for double what you paid for it, right? Well, I think we're going to get back to the fundamentals of real estate, which is buy a deal, make money now, make money when you close it, and make more money as you hold it, and try and hold it for as long as you can. Real estate's become this hot potato game, where it's like, oh, the market's taken off. And the last time I saw that, where people were buying stuff and then trying to unload it as quickly as they could to play musical chairs and pass the hot potato to the person next to them. The last time I saw that was in 2005, 6, 7. And so we're seeing that again on big multifamilies, where people, as soon as they buy it, are like, well, can I get another $5K a door for this thing if I flip it right now? You remember back in the day where people, you said you weren't involved in real estate as much back then, but I remember big thing in 2007 and 8 were condos, right? Mm-hmm. Everybody's building condos. Right. Philly was a condo boom. Miami was a condo boom, so much so that people would buy. I would put an unbuilt condo tower was going up, right? I'd put a unit under contract for a $500 deposit for, like, say $400K. I'm going to buy a higher level unit that's higher up the building with a better view, right? $400K. I would then flip my contract literally in Herve, like a month or two from now, and make like $100K selling the contract downline to the next person. And people were flipping these contracts over and over and over again to buy these to sell off condo units, on a $500 deposit, and making tons and tons of money. What's happened in the last couple of years with multifamily kind of feels like that. Nobody wants to hold it to make money during, because they're not making any money during the hold cycle. They're hoping to make money to get caught up when they sell it. It's not sustainable.
That model of so-called flipping a multifamily now, right? This is the buy and sell in 2-3 years, kind of put a little capital into it. It's symptomatic of the marketing and the show that has been put around the real estate industry, particularly when it pertains to flip. Turn on your TV right now. It's a good chance you're going to see some show of people flipping something. Oh, flipping in Vegas, flipping at 50-50, 9 figures, and right? This is all kind of flippers on the home shopping, not the home, but the 8G network, all those networks, right? Flip. But those are obviously single family homes from across the country, Vegas, Miami, Tampa, all over. Now you're doing that almost concept same wise in multifamily. Hey, I seen them. They hit my desk every doggone day. Class A, sexy, brand new features through the roof, iPads to get into your complex dog wash, car wash, or pickleball courts, and all this other fancy stuff and everything. Right? You come in, $50,000 minimum investment. These things got a skinny cash on cash return, but they got a 40% IRR because they're going to be selling it in 2
I wouldn't touch that. I wouldn't touch those deals with a 10-foot pole array. You don't even forward. You and I don't even look at stuff like that, because there's no money in that deal, but it sure is sexy. It'll show you. I'll bet you the marketing package looks glorious. Yeah.
I know some operators, they're to be unnamed. I know some operators, man, the claws are beautiful. There's a swimming pool, Olympic size, clear blue.
Sure. Those guys out there, all they buy is stuff that's inside of 5 years old. And I get it. And that probably worked 5 years ago. Yeah. But I don't think that's the
rents were like this
play anymore. I mean, not at a 4 cap anymore. And the problem is the other article that you and I talked about, Herve, about how there's millions of units of multifamily in pipeline right now about to be developed. Right? They're about to come online. There's so much multifamily in construction. And let me ask you a question. What are those big multifamilies that are in construction right now? When they hit the market, who are they going to compete with? Not us, not C-class, not tertiary markets. They're going to compete with the stuff that was built in the last 5 years, because they're not going to get their price targets. But so that they can stay alive, they're going to find whatever way they can to drop their rents. And there's going to be a price correction. I think like A-class is due for a rent price correction. 100%. Once that happens, that's going to cause a lot of pressure on A and B class real estate, because they're just not going to make the rents they used to, because there's going to start to become concessions and price drops, whatever, in certain markets. Real estate is not a national thing. Real estate is all market specific. but you're going to see price cuts in your big top tier markets. This happened in Philly. I had a buddy of mine renew his lease in Philly years and years ago when there was a development glut in Philadelphia, because Philly went through this like 5 years ago, right? Mm-hmm. They're not in it now, but Philly was a different place 5 years ago. It was, on the uptick, right? So buddy of mine renewed his lease. Landlord got him to renew it for 2 years, and they gave him 3 months survey for free.
First 3 months of rent free. Woo!
The first 3 months rent free, but he had to sign a 2-year contract. So wanted to lock him in, and they also did, they're smart, which is not for nothing. That's what we do too. You don't give you don't like drop your rents. You just give concessions so you can maintain market rent and say, well, a 2-bedroom is $2,500. But if you sign this lease for $2,500 for that 2-bedroom, I'll give you the first 2 months free. So technically, I'm giving you 16% off. Got that? Think about that deal, man. That's 1 month is 8% of your rent for the year, right? So he got 3 months off. That's 25% off the first year. Crazy. You're going to see more of that, and then that's going to really cause some interesting pressure.
That marks from that one person. That marks down your NOI by that much, right? By 25%, right?
For that one unit, yes.
You're going to see operators start to put those Class A deals that they bought in the past 5 years on the market to be sold. They're not going to be able to operate them, Matt. They're not with incoming supply into those tier 1 primary cities, the Atlantas, Dallas.
But it's not really, not really our thing. Unless we decided to pivot. A wise man told me years ago, you can't change the market. You can only hope but to participate in it. So if somebody approached us with a fire sale A-class that was built 5 years ago that they really need to unload for a phenomenal number. I don't think Herve and I are going to turn our nose up on it, but we just don't see opportunities in that space regularly. But you never know, right?
It's, going back a little bit to what happened in Houston, I would just tell folks, right, if you're starting your own, real estate venture, if you're looking to get your first 4-plex, 5-plex, whatever it might be, for the love of God, I ask you to be disciplined. With our underwriter today, we were reviewing a deal that was given to us earlier this week by a big commercial broker. This was a deal in South Carolina. It looked real interesting. I like this town in South Carolina a lot. I'm like, man, I hope the numbers work out here. And so, Vinny, I was reviewing it with Haith this morning, and he brought up it was on Google Meet. He's sharing the underwriting with me. And I'm like, you got to be kidding me. What is this thing? Vinny, the deal had, I don't think I've seen this before. The deal had negative cash flow. Day 1, not year 5 or year 7. Yeah, today. I said, hey, what's going on here? How is this thing negative cash flow? The current owner bought the property just 2 years ago for $95,000 per door. They're trying to sell it today for $120,000 per door. And I said, why is this thing negative cash flow right now? Hey, what's going on? And he says, listen, this thing has over 200 units. They went ahead and they already had renovated about 150 to 160 units. So there's only about 40 units left to be renovated. So, you're capped on your value add. On top of that, they're running this thing at about a 30% OpEx. So basically just running it very lean. They weren't charging a management fee. It was bananas. And I said, no one's going to buy this deal. So all I'm telling you folks is just do your homework as these deals are being presented to you.
I'm telling you, they agree that there's still, I know it's last call, but even after last call, people still slip a few drinks past the bartender and you still sip the one that you got. You kind of slow sip the one you got before you got to go home, right? Last call has been called. The party's over, but people just don't know it yet, right? So the mortgage the greed gland is still going. And so that person you just mentioned, they're going to sell that deal because a mortgage broker, the buyer's going to find a way to convince equity that, what if cap rates go down to 3%? Well, that'll make the property sell for even more than what I paid for it 5 years from now, whatever it is. They'll be able to paint a financial picture. They'll be able to figure it out. I don't wish ill will on anyone, but I do think that until buyers just start pushing directly back on the market and say, no, I'm not paying your 4.5% cap rate. I'm not paying your 4% cap rate. I'm not. You got to give me something that makes sense. And this deal doesn't make sense at these numbers. The party's going to keep going.
Well, you and I know there's a lot of sellers out there, right? This was a quote unquote off market deal, right? And in the world of off market,
you know what that means? Yeah.
They were just testing the market, and this test, I believe, will fail. Some tests pass and some fail. I think this one is going to fail because it's so bad, and that's why we've heard deals that we looked at earlier this year that were on the market to be sold did not sell for one reason or another. Many times because they were not able to find the price or get the price that they wanted to. And so that deal was now left in the hands of the original owner. They're maybe try to refi it if they can get their DSCR up, which is a challenge in this environment, we all know, and so on and so forth. So I think you're seeing some of these so-called off-market deals hitting the market because the seller knows, listen, I better do something with this thing now because in October, I'm not going to have the opportunity to do it. So let me just try to get rid of this thing now at a price that I know may not make any sense whatsoever, but let's go ahead and try to do it anyway. And if they fail, then they're left holding it. And that's, I literally heard this 2 days ago from a broker on a deal that we had submitted an offer in early March. Sure enough, they were not able to go ahead and get their price. So they're going to try now to do a refi on the deal. Some tests work, some tests don't work. We'll see. But if any of you out there have an itchy trigger finger to go ahead and do your first deal, I get it. Sometimes I feel that way as I'm analyzing a deal. Oh my God, we got to do a deal. We got to do a deal. We got to do a deal. Before we got to do a deal, you got to be patient.
Guys, amazing conversation. Just a little taste of our thoughts here. I hope you guys found it to be valid. Once again, if you guys want to hear more about what we're up to, go to DeRosaGroup.com and make sure you like and subscribe this video. You guys watched it to the end. You must have liked it. So like it for us and subscribe to the channel so you can hear more of the cool stuff that we're up to. See you next time, guys.